Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Hope you're well. Just finished up the first quarter. It's feeling like spring. Weather's getting warmer. Wanted to do a quick review of the first quarter of what's happened so far and give you a few things to think about in the coming weeks. All right. First quarter was a bit challenging, I'd say, overall. The S&P for the quarter was down about 4.3. The NASDAQ, with some technology disruptions, down 7. International investments down slightly, and the bond market pretty flat. First couple weeks of April have been a bit better. The S&P 500 is off of its lows, down only 3.5. The NASDAQ has recovered a bit, down 5.7. International stocks have become positive, and the bond market still remains flat. So pretty mixed for the first 3.5 months of the year. In terms of the S&P, we are often looking for entry points into indexes when they decline by more than 10%, a double-digit decline. Didn't quite get there for the S&P 500 in March. It was down about 7.6%, but then had a little bit of a recovery at the end of the month and into early April, now down only 5. So we didn't quite see that double-digit decline that we often use as an entry point for the S&P 500. Keep in mind, market declines are a part of any year, and it is quite common to have more than a double-digit market decline and for the market to still be positive by the end of the year. You've seen this chart before, but if you haven't, this is every year going back to 1980. The column on the left that says max intra-year drawdown, that means during the year, how much did the market drop? And the column to the right of it is, but at the end of the year, what was the overall market return? And what you can see is that the average drawdown during a year is over 14%, meaning it's quite common during a year to see the market drop by more than double digits. But if we take a look at the end of year return over this time frame, the average end of year return is positive 13. So if we're talking averages, average return is positive 13 and average dip during the year is negative 14. So to see the S&P go down 7 or 8% during the month of March is not uncommon. That's sort of normal market volatility. Now, why the market dropped in particular is unusual. It's a geopolitical event happening in Iran and can have a lot of different impacts to it. From a economic standpoint, rising oil prices or rising energy prices can have a big impact on all kinds of economies. But geopolitical events have happened in the past and they'll happen in the future. And it's important not to make an investment decision or try to trade short term on any sort of geopolitical event. If we take a look at this chart here in front of you, whether we're talking about the Korean War, the Cuban Missile Crisis, the Gulf War, invasion of Iraq, Brexit vote, COVID-19, the average return of the market 12 months after a geopolitical event begins is positive 14%. So in these examples, if you didn't panic or worry about the world's events, if you simply just held on to the S&P 500 index over that time frame, positive 14% return over that time. It is very difficult and not encouraged to try to trade short-term market fluctuation due to a geopolitical event. From a sector standpoint, there's 11 sectors year to date. 5 out of the 11 are positive. No surprise, energy has been the top returning sector since oil prices have risen. Other positive sectors would include industrials, which is where you would find a lot of defense companies, as well as what are sometimes thought of as safe havens during volatile times, consumer staples, and utilities. There are 6 negative sectors year to date. The technology sector, is roughly a third of the S&P 500, so it's the largest sector. That's down about 9%. Earlier in March, a company called Anthropic, which is developing some amazing technologies, so amazing that a number of the software companies within the S&P 500 will likely be disrupted in terms of their technology. So there's been a big sell-off in the tech sector, and that is the sector that has hurt the overall return of the market the most. Conflict in the Middle East has, at least in the short term, forced oil prices and energy prices much higher. And the longer that oil prices remain higher, more expensive transportation costs to get anything from point A to point B becomes. Takes money out of the pocket of consumers, makes companies less profitable. So lots of negative effects to that. But this is not the first time that investors or our economy have dealt with oil over $100 a barrel. It's been nice over the last few years to not have that, but we saw it in 2022. and we saw it more than a decade ago. So not something that we want to get used to, but you can have positive stock markets with oil um, at $100 or higher. So rooting for the price to come down, but still believe that you can have positive investment markets when oil prices are high. It's a choppy first quarter, disruptions in the technology sector, geopolitical events, rising oil prices. So a lot going on. But the market has not yet seen a double-digit decline, which is typically a solid entry point. Plenty of places to find positive returns by sector in the S&P year to date. So we'll touch base again in about a month or so. We'll send you an update. Hopefully, this geopolitical event is behind us. We're now coming into what's called earnings season. So companies over the next couple of weeks will be reporting their earnings from the first quarter. How did they do? How have rising energy costs impacted them? And what's their view for the upcoming quarter and beyond. So thanks as always for your trust and confidence. If you need anything, please don't hesitate to reach out to the advisor on the team that you connect with the most. And we'll see you again in a month or so.